Welcome to Luxona, where millionaires are made. I'm about to tell you something that might make you uncomfortable, but it's a truth that could save you from decades of financial misunderstanding. Your house is not an investment. I know. You've been told your whole life that buying a house is the smartest financial move you can make. Your parents said it. Your real estate agent definitely said it. Even your neighbor who bought their house 20 years ago keeps bragging about how much it's worth now. But here's the thing, and this is where we separate the millionaire mindset from everyone else. Just because something goes up in value doesn't make it a good investment. Let me break this down for you in a way that's going to change how you think about money forever. When you buy a house with a mortgage, you're not investing, you're taking on debt. Big difference. Let's say you buy a house for $400,000 with a 6% mortgage. That house needs to appreciate by more than 6% every single year, just for you to break even on the interest you're paying. But here's the reality check. Homes in most areas appreciate at about 3 to 4% annually over the long term. Do the math with me here. You're paying 6% in interest, but your house is only going up 3 to 4% in value. That's a losing proposition from day one. But wait, it gets worse. That mortgage interest is just the beginning of your expenses. Let's talk about the real cost of home ownership that nobody wants to discuss. Property taxes, typically 1 to 2% of your home's value every year. Homeowners insurance, another $1,000 to $3,000 annually depending on where you live. Maintenance and repairs, and if you think this won't apply to you, you're in for a rude awakening. The general rule is 1 to 3% of your home's value annually for maintenance. On a $400,000 house, that's $4,000 to $12,000 every year, just to keep it from falling apart. And here's the kicker that really gets people emotional. When you sell that house, you don't keep all that appreciation anyway. Real estate agents take their cut, typically 6% of the sale price. On a $400,000 house, that's $24,000 gone immediately. Then there are closing costs, transfer taxes, and all the other fees that somehow nobody mentions when they're telling you about this amazing investment. So let's run the numbers honestly. You buy a house for $400,000. After 10 years, it appreciates to $500,000. Sounds great, right? $100,000 in profit. But hold on. You paid 6% interest on your mortgage for 10 years. On a $400,000 loan, that's roughly $24,000 in interest every single year. So $240,000 in interest over 10 years. You paid property taxes, let's say $15,000 annually, so $150,000 over 10 years. Insurance, maintenance, repairs, let's conservatively estimate another $100,000 over that decade. When you sell, the realtor takes $30,000 based on that $500,000 sale price. Are you starting to see the problem? Your house went up $100,000 in value, but you spent over $500,000 in interest, taxes, insurance, and maintenance to own it. This is not an investment. This is an expensive place to live. Now, I can already hear some of you getting defensive. But I'm building equity. Yes, you are building some equity, but let's be honest about what equity really is. Equity is just the difference between what your house is worth and what you owe on it. It's not cash in your pocket. You can't spend equity unless you sell your house or take out another loan against it. And if you take out another loan, congratulations, you just added more debt to your life. Here's where the forced savings account concept comes in, and this is actually the most honest way to think about home ownership. When you make a mortgage payment, part of that payment goes toward the principal balance, which does build equity over time. This acts like a forced savings account because you have to make that payment every month, and some of it goes toward ownership rather than just interest. But let's compare this to actual investing for a moment. If instead of buying that $400,000 house, you rented a similar place for, let's say, $2,000 a month, and you invested the difference between that rent payment and what you would have paid for mortgage, taxes, insurance, and maintenance, you'd likely come out way ahead. The stock market has historically returned about 10% annually over long periods. Even if we're conservative and say 7%, your money would grow much faster in actual investments than it would sitting in your house. But here's where people get confused about renting versus buying in 2025. They say renting is throwing money away. This is one of the biggest financial myths that keeps people trapped in mediocre financial decisions. When you rent, yes, that money is gone every month. But when you pay mortgage interest, property taxes, insurance, and maintenance, that money is also gone every month. The only difference is that with renting, you're not pretending it's an investment. Let's talk about what real estate myths are doing to your financial future. The myth of leverage returns is probably the most dangerous one. People say, but I only put 20% down and I get appreciation on the full value of the house, so that's leverage returns. This sounds sophisticated, but it's missing the point entirely. Yes, if you put $80,000 down on a $400,000 house and it goes up to $500,000, you made $100,000 on your $80,000 investment. That sounds like a great return, until you factor in all those other costs we just discussed, plus the fact that you're paying interest on the $320,000 you borrowed. Real leverage in investing means using borrowed money to buy assets that produce more income than the cost of borrowing. When wealthy people use leverage, they're buying income-producing real estate, businesses, or other investments that generate cash flow. Your primary residence doesn't generate cash flow, it generates bills. This brings us to how wealthy people actually think about real estate and the millionaire mindset around home ownership. Wealthy people buy income-producing assets first. They buy rental properties, businesses, stocks, bonds, anything that puts money in their pocket every month. Then, after they have multiple income streams, they might buy a nice house to live in. But they never confuse their personal residence with their investment portfolio. The financially educated understand that there's a difference between assets and liabilities. An asset puts money in your pocket. A liability takes money out of your pocket. Your house, no matter how much you love it, takes money out of your pocket every month. That makes it a liability, not an asset. Now let me be clear about something important. None of this means you shouldn't buy a house. Home ownership can be a great choice for many reasons. Stability for your family, the ability to customize your living space, protection from rent increases, and yes, the forced savings aspect we discussed. These are all valid reasons to buy a house. What I'm saying is, don't buy a house thinking it's going to make you wealthy, because in most cases, it won't. Here's the truth about financial education that most people never learn. Real wealth comes from owning assets that produce income, rental properties that generate positive cash flow, businesses that generate profits, dividend-paying stocks, bonds, intellectual property, anything that makes you money while you sleep. Your primary residence, while it might appreciate over time, doesn't generate income. It costs you money to maintain and own. The key is shifting your mindset from thinking like a consumer to thinking like an investor. Consumers buy houses, hoping they'll go up in value. Investors buy income-producing assets and let the cash flow compound over time. This is the difference between hoping to get rich and actually building wealth systematically. So what should you do with this information? First, if you're going to buy a house, buy it for the right reasons. Buy it because you want stability, because you want to customize your space, because you want to plant roots in a community. Don't buy it thinking it's your path to financial freedom. Second, focus on building real wealth through actual investments. Start with your employer's retirement plan, especially if they match contributions. Invest in diversified index funds. Learn about real estate investing if that interests you, but focus on properties that generate rental income, not just appreciation. Third, if you do buy a house, don't let it become your only financial strategy. Too many people put all their extra money into their mortgage, thinking they're building wealth. Meanwhile, they miss out on decades of compound growth in actual investments. The bottom line is this: buying a house can be a good personal choice, but it's not a wealth-building strategy. Real financial freedom comes from owning assets that work for you, not liabilities that you work for. Once you understand this distinction, you can make housing decisions that serve your lifestyle while building actual wealth through real investments. That's the millionaire mindset. That's how wealth is really built. And that's why your house, as much as you might love it, is not the investment you think it is.